We continue with our discussion on working capital management under FSA. This is towards the last section of working capital management, and our attention in this section is going to be primarily towards what are the determinants of working capital. How do we know what the working capital would be? We've discussed a little bit of this in the past, and we're going to look at basic management of working capital and a summary of whatever we have learned so far. Right? So that's going to be the bulk of our discussion in this particular section. Now, let's understand what are the key determinants of working capital. Companies need to invest in some capital in the form of working capital. And what is working capital? Working capital is going to be non-cash current assets minus current liabilities. This is because this essentially funds growth, right? So growth will come from your working capital that you have invested in the business. How? Inventory that you have will generate future sales, and better credit terms in terms of receivables being there is going to attract buyers as well, right? So that's the growth is going to come from your working capital management. At the same time, in case there are any kind of cash flow problems, then this is something that if need be can be quickly converted to cash. We've already seen there is a trade-off between risk and reward in terms of higher versus lower working capital requirements, right? So the trade-off is that it can provide us with liquidity in the case of trouble, but keeping working capital will block some amount of cash in terms of inventory or receivables, right? So the key questions that come to our mind while analyzing any business, right? So our concept is whenever we are analyzing a business, our mind needs to ask a couple of questions. What are those? How much working capital is actually good for the firm? Not what they're keeping, but how much is good? And what are the factors that determine the level of working capital in a firm? Right? So how do we come up with these numbers? How do we look at these numbers? Is going to be, or answer these questions is going to be a crux of our discussion now. So the key determinants of working capital. The key determinants are what we're going to kind of work on now. So let's look at what determines the working capital. So we've already seen a couple of these, which is the nature of the businesses, right? Typically, services businesses catering to retail clientele do not need a lot of working capital because most of the money is being paid in advance. We had already seen B2C companies or businesses will have a scenario where you're targeting retail clients, you're targeting individuals, and individuals cannot really get the delivery of a product or a service before or without paying for it, right? So there are lesser working capital requirements like this. So autos like two-wheelers, telecom companies, education, schools, colleges, the individual making a payment, you could add a few more like cinemas, etc., where individuals are making the payments, and B2C companies typically have a big scenario of having lower working capital requirement. On the other hand, businesses with manufacturing setup need higher working capital requirements because typically you are selling to large corporate clients, right? So you have a B2B model will essentially need higher working capital requirements, right? Airtel, HUL, anything that is selling to B2C is usually low requirement of working capital. Anything that is B2B would have a positive and higher working capital requirements coming in. So the nature of the business is the first key determinant in terms of what is going to be the working capital, right? The next one comes in terms of size of the company. Once again, we had seen that a dominant company with a big market share, right, or someone who's a leader in the segment will have a scenario where its bargaining power keeps becoming better and better. For example, a company like Hero MotoCorp is able to get much better terms from its suppliers just because the material ordered is huge. So larger companies would have huge or benefit in terms of working capital management or lower working capital requirement because they have huge bargaining power with the suppliers. A smaller company does not enjoy such terms with suppliers. neither does it have the benefits of economies of scale, right? When you order a lot of quantity, you can get favorable pricing. When you are a dominant player, you can get favorable pricing. So size of the business works in both ways. A larger capital goods firm, on the other hand, for example, will have higher working capital requirements. So now, if you are a B2B firm and you are large, it sometimes might mean larger working capital requirement because you'll have a bigger inventory, you'll have a bigger receivable segment, etc. Whereas if you're B2C and you're large, it'll almost always mean lower working capital requirement. In fact, you could have negative working capital in most of the cases, right? What else? Now, there are some other factors. These two we had already discussed. The size of the business and the nature of the business we had already discussed. But there are some other segments which basically, or some other determinants which also come into picture. So for example, seasonality. Now, seasonality could be in two sense. Seasonality is, there are times when demand jumps up, then time when demand goes down, then demand jumps up, then demand goes down, right? So when the demand is high, for example, the festive season in India, if you look at the seasons between October, the months between October and November, and also to an extent December, this practically is the festive season in India. It's expected that there is a higher demand for a lot of things. What kind of things? You have higher demand for electronics, you have a higher demand for autos. So at this point of time, just prior to this, the working capital needs might be high. The companies might need to maintain higher inventories at this point of time. So companies manage higher inventories in order to meet this higher demand. That's one part of the seasonality of the business. Then sometimes in certain businesses, raw materials are seasonal. So you only get the raw material at a particular point of time in the year, right? So there the company will have to buy the inventory and keep the raw material stocked for the entire year. Take for example sugar, right? Now typically wherever you have agri commodities as input, right? If this is the input, this becomes seasonal in nature because the crops are seasonal in nature, and hence the company will have to maintain an inventory or stock of the raw material, right? So if the input of the business includes a seasonal commodity like sugar or sugarcane or cotton or kind of a thing, then you would want to kind of manage a little bit of an inventory around that. So this seasonality may also mean, something in terms of being a key determinant for working capital. Now, it's quite possible that a sugar company is a B2C company and it's a large company, but they may still want to maintain inventory because the business demands so, right? They may want to maintain inventory because the business demands a seasonality, and it results in sometimes better price management, better prices that they can derive out of the sugar if they have the inventory at that point of time. Similarly, firms may want to maintain a high inventory around the festive season because a stock out here, right, which is you running out of inventory, would mean straight away lost sales. If I have to buy a television in the month of October just before Diwali, I will buy a television. If a company does not have the inventory of television at that point of time, it will mean a lost sale. I'll move to some other brand and buy that out, right? So seasonality becomes a key component of working capital, sometimes inherent into the nature of the business, sometimes inherent because of seasonal pickup and dip in the demand cycle of the business, right? Then there are some other key determinants as well. So if the production cycle of a business is, long, if you have a long production cycle, let's take, for example, a business that manufactures aircraft parts, right? Now it'll take long time to produce it, right? And so if you get the demand today, you will not be able to immediately cater to it. And so in some cases, in this case, when the goods take longer to produce, the nature of the business is such that you may have a higher working capital requirement. Some of these manufacturer of aircraft parts, right, companies like Boeing, may want to keep inventory so that they can supply parts whenever needed, right? So whenever there is a sudden requirement, you can supply. So whenever sudden need comes up, you can supply. Now, in these cases, the need is absolutely important at the time. If an aircraft company, if an airline needs a particular part of an aircraft, they need it right now. They can't ground the aircraft for the next 6 months till the time it gets produced. So in a lot of these cases where you have long production cycles, companies which are producing goods with long production cycles, in order to have better client loyalties, right, may choose to maintain inventory so that the client will come directly to them in the case of this requirement, right? An Indigo or a Jet will immediately go to Boeing and say, look, I need this part. I cannot go to anyone else because no one keeps it. You keep it, right? So that's why sometimes there could be higher working capital requirements. Similarly, economic environment could have an impact. So during recessions, inventories pile up, thereby increasing working capital requirements. In the recovery phase after recession, these inventories are first cleared, thus resulting in declining working capital. So what cycle or what part of the economic cycle you are in also determines to an extent what is going to be the exact requirement of working capital in a business. So in addition to the fact that you have the nature of the business and size of the company that determines, the other factors that determine are seasonality, production cycles, and the external economic environment. These could result in some sort of movement in your working capital needs from time to time, and that's exactly what combines. And as an analyst, you need to evaluate all these parameters before you kind of come up with a judgment whether working capital is high or low or good or bad, right? So that becomes extremely important for us to kind of understand. Now, to manage working capital at reasonable and stable level, companies have a lot of options. They can manage inventories, they can manage receivables, they can manage payables, and they can manage cash as well. Now, cash is an outcome of this entire data point, so we'll discuss cash separately. We've already seen companies like Maruti maintain low inventory, and that's a part of their entire working capital management process. Receivables management also separately becomes important because you don't want to increase sales only on account of credit sales, right? So some companies are remarkably good with receivables management. Important because it kind of ties up cash, but at the same time, credit does allow you to sell more. So you have to find that fine balance between receivables management and payables. You don't want to, so you want to delay, but not too much, right? So that you don't shortchange your supplier too much. You want to maintain good terms with your suppliers as well, right? So once again, Maruti, for example, manages low inventory, but at the same time does not delay payables, and they don't have receivables. So by nature of the business management, receivables are close to zero, low. They manage low inventory, and payables are also kind of manageable, right? So it's not very high. And why is it manageable is because they don't want their suppliers to feel bad about where they are. Their suppliers to feel about how are they going to get money by, and when are they going to get money. So Maruti has said that we've discussed this, that all the suppliers need to be in a vicinity of the Maruti plant so that they're able to kind of get their supplies faster, thereby managing lower inventory. And by managing lower inventory, they can make the payments to the suppliers faster. Right. So those are the key components. We've seen the management of inventory. We've seen the management of receivables. We have to see that companies keep these numbers as stable. We have to see that they're not keeping too much inventory as compared to other players in the sector. We have to see the same for receivables and payables as well, right? That's the broad component of how working capital management would work. Now, let's understand cash management. Now, cash requirement in a business could be for multiple reasons. There are some businesses which are conservative businesses, so they generally like keeping a lot of cash. There are some businesses that are aggressive businesses, so they say we will only keep cash if need be, otherwise we'll return all the cash. There are some businesses that generate a lot of cash, cash generators. Any examples of cash generators? Apple is a classic example. They generate significant amount of cash on a daily basis. I mean, they're about a $10 billion profit company every quarter, right? Then you have ITC, tobacco business. Cigarette sales generate a lot of cash for them. There are, on the other hand, some other businesses which are not necessarily going to generate cash, but they are going to kind of eat up cash, right? So cash guzzlers, essentially. These businesses eat up cash. So your businesses like construction, your businesses like real estate, these are businesses which will keep up a lot of cash tied up in the business all points of time, right? So now, what do you need cash for? You need cash for transactions. If sales can be forecast accurately, like in power sector, less cash is needed. Now, wherever sales cannot be forecast accurately, you do need a little bit of cash in terms of transactional requirements all the time. Precautionary motive is the next motive. Now, just in case things don't go as per plan, things go bad, your relationship with cash providers like banks is not good, you may want to keep a little bit of precautionary cash on your balance sheet. You never know when the need arises, right? And then you might want to kind of have speculative motives, like a firm that uses up commodity inputs. They may hoard cash just in case they expect raw material prices declining. So a construction firm might, for example, buy steel whenever steel prices fall, and for that they may want to keep some cash. You can keep cash for transactions, you can keep it for precautionary motives, you can keep it for speculative motives. Typically, precautionary motives is fine, and transactions has to be as low as possible because cash has a cost. Keeping it in the bank is not going to really generate significant amounts for the company, but it's kind of perceived as equity holders' money, right? And equity holders demand a return on the equity. So it's not like it is free money that is lying idle. You do need to generate something on it. So you don't have to keep too much cash. Infosys is a classic example of a conservative company. They have kept large amounts of cash to be able to run business operations smoothly. In fact, they own about 30,000 crore of cash, and they typically say that we should be able to give 1 year salaries to people, even if there is no business that is getting generated. Even if we have zero business, we should be able to provide 1 year of salaries to people. And if you look at their numbers, the salaries of everyone included in the company for 1 year is about that number. So they always maintain that amount of cash. That's a precautionary motive. Some companies keep cash, some companies don't. Some companies get debt, some companies don't, right? So it's not bad to keep cash. It's just from management to management, you want to kind of have a little cushion in your business operations. And that is why you keep a little bit of cash. Infi is a classic example. There are other examples of companies as well who hold cash. Apple is another example. A lot of FMCG companies don't use any debt. They keep their cash with them. So that's completely dependent on firm to firm. But if you have evidence that a company is holding cash but not really using it well, or is holding it for speculative motives, then you may want to view that as a slightly negative, analysis on the management, right? That's broadly how you kind of hold cash. Let's quickly summarize whatever we have kind of learned about working capital management. Point one. Sustainable negative working capital is good. It has to be by choice, which means the company is able to do it. Typically, you will find B2C companies, large market shares, are going to have a sustainable negative working capital. It's paying its suppliers after it is receiving its payments, and it's keeping less inventory, right? If not this, then a steady positive working capital is manageable. So working capital should be stable as percentage of sales. If sales grows, working capital requirements will grow, inventory requirements will grow, receivable requirements will grow, payables will also increase, right? Typically, most firms are not able to manage negative working capital. So, they will have to extend receivables. Inventory management is not best as well. But as long as it is stable, it remains stable or steady, and it remains kind of in manageable proportion as percentage of sales, you can arrange for it without too much of a problem, because you can plan for it, right? If sales is increasing and inventory is going to double, you can borrow that cash from somewhere and try and manage that, right? Volatile working capital. And when I say volatile working capital as percentage of sales. So if inventory is 10% of sales in one year, 20% in the next year, 30% in the year after that, and 10% again after that, then you cannot really plan your business accordingly. The firm will have a problem in managing these working capital requirements. And sudden movement of positive to negative could be a problem. Now, while negative working capital is good, remember the key word being choice. So if suddenly positive changes to negative, that's most likely because current liabilities have gone up. Why have current liabilities gone up? Why have CL gone up? You need to be able to answer this clearly, right? So that's the broad sheet that you need to kind of put in your mind about how do you view working capital of a company. Obviously, after you've done this analysis, you do need to check for factors like seasonality and production cycles, right? And if you're convinced that the company needs to do it because of seasonality, then they can keep higher inventory. But in general, lower proportions of working capital as percentage of sales are considered good, right? Let's take an example. Now, we take an example from the clothing retail space, and we have companies with the name of Provogue and Keval Kiran. Provogue is a more well-known company. Keval Kiran is the company that manufactures killer jeans, right? Now, similar businesses, they're in clothing retail. They have stores where you can go and buy clothes. Look at the management of working capital. So receivables as percentage of sales for this company has moved to around 40%. Inventory is around 40% of sales, right? Now, for a clothing retail business, why should receivables be so high? Right? We buy a shirt, we buy a trouser, we pay for it there and then. Why should receivable be so high? Correct? Similarly, if you're keeping so much inventory in a retail business, that's going to create a problem. Payables, on the other hand, are around 13%. Now compare this to a company like Keval Kiran, where receivables are about close to 16% of sales, which is about 2 months worth of sales. Inventory is about 11%, which is again about a month and a half worth of sales. Every 1.5 months, they kind of change whatever is there in the store. So new fresh brands and fresh production comes into the store, thereby increasing the likelihood of more people buying it. Payables are almost similar to what Provogue has. Which one looks better, right? From whatever we've learned so far, we find lower working capital and stable working capital as percentage of sales is considered good. So we would tend to think that Keval Kiran is better managed, right? How does the stock market react to this? So the blue one is Keval Kiran, and this is like normalized numbers. If you invest 100 rupees in both the companies between 2012 and 2014, 2 years, at the end of the 2 years, in one case, 100 becomes close to about 170, 180, right? Whereas in the other case, your 100 invested, which is in the case of Provogue, your 100 invested ends up at around 50. So in one case, in the case of Provogue, you have had a minus 50% return. In the other case, you have had a plus 80% return. That's not to say that this is the only factor, but working capital management is a major factor in terms of analyzing how a business is run, right? And that's the important learning that we ought to have from this particular section, this particular data point that we have seen. That's the important idea on working capital management, right? Now, as an exercise, what we're going to do at the end of this particular video is we're going to use the data on Eicher Motors that we have been working on. We're going to try and calculate working capital on their data. So we arrive at the data points. If you remember, we have already calculated working capital in terms of the inventory turnover, receivable turnover ratios, right? We can also calculate what is the payable turnover ratio. So I'll insert a row here and we can calculate payable turnover ratio. And that's going to be sales by payables, right? And we go to the P&L, we look at the sales. Let's recall we're using 8, row number 8. So we're going to go to the P&L and we are going to use row number 8 and divide this on the balance sheet by trade payables, right? And we get our payable turnover ratio as well. Now recall that turnover ratios are available with us. Can I find working capital ratios in terms of days notation, right? So when we calculate the cash conversion cycle, can I calculate inventory days? What is that? That's given by 365 divided by inventory turnover ratio. Similarly, receivable days are going to get calculated by 365 divided by receivable turnover ratio, and payable days are going to get calculated by 365 divided by payable turnover ratio. Let's calculate that. So 365 divided by my inventory turnover ratio, and I can drag it on the right side, I can drag it down. What does this mean? So we can also calculate the cash conversion cycle. How do we get that? Inventory days plus receivable days minus payable days. And we find that's almost close to 0. So effectively, and that's increasing. So the negative cash conversion cycle is becoming better. Company ends up paying money only after it has received all the money. Now, look at a few things here. Let's check about negative working capital. So for all practical purposes, while we do need to consider the other data points as well, if I calculate non-cash current assets, what are the non-cash current assets? We can go to the balance sheet, we can look at all the current assets, and from this we can subtract the cash and cash equivalents and current investments. Why current investments? Is because they are also kind of cash equivalents, right? That's the non-cash current assets. Do we have the current liabilities? That's available with us directly on the balance sheet. We can find them here. We can format this and drag it on the right side. Does the company have a negative working capital or a positive working capital? So we have A minus B and we kind of extend it. So we do find negative working capital. Is it stable as a proportion of sales? So if we calculate working capital as percentage of sales, I will divide minus 374 by the amount of sales that they have here, net sales, and we find it is negative 6%. Where has it gone to over the period? It's increased. It's become better in terms of the working capital management. So it's negative 6 becoming negative 10, improving. And why do we say it is improving? Is because payables have been extended a little bit. Inventory is absolutely stable, right? 28 days worth of sales is outstanding as inventory. Receivables are largely stable, right? And there is a slight increase in payables. So all this points to the key tick points. What are those key tick points? We have negative working capital
and that's a positive for us. So we're going to kind of say this is good. It's improving. It's becoming more negative. That's a positive. All these are stable. That's a positive. So the company basically runs a business. It's a B2C business. They sell bikes. They also sell commercial vehicles, but the larger proportion of their profits at this point of time is coming from the bikes. And that's why this company seems to be showing you negative working capital, improving negative working capital because they're gaining market share in their bikes division. And commercial vehicles is also doing well. And that is the purpose of our analysis that we do for this particular company, right? So that's working capital ratios. That's the discussion on working capital ratios. We go back to our presentation very quickly and end this with a key discussion on you need to discuss what are the key determinants of working capital for any firm. Just note them down and revise this.